Well, I have a series of graphs that I would like to show you in order to go deeper into the various themes presented by Mr. Ignazio Angeloni. Of course, there's a positive assessment and judgment of regulatory activities already mentioned, as well as of the supervisory activity adopted starting back in time in 2014 and until the year 2015. There are a series of topics that we should discuss, and I would like very briefly to do this in the light of a few graphs that show you the status of the European banking system in terms of liquidity, capitals, and requirements. So we will see what challenges have got to be faced at the European level on top of the themes that have been already introduced and presented to you by Mr. Angeloni. Some of the evidences here show you the differentiation degree or homogeneity we have in the European bank system, as well as what we still have to do. So, no doubt, and this is my first point, no doubt, as Mr. Angeloni mentioned earlier, the banking system has a solidity level now that is greater compared to the starting point. Mr. Angeloni showed the situation at the very start of the crisis, and here you see that the European banking system have a capitalization level that is greater, with 6 percentage points, show a quite remarkable difference from country to country. I will refer to the Italian context, but always in a European framework. The Italian system has had a capital increase that is similar to that of the other European countries. When talking about the current levels whereby the banking system is not amongst the most capitalized system, we have to remember that major public interventions have taken place in the recapitalization measures taken since the start of the crisis. Some countries have been benefiting from it to a wide extent, and the recapitalization of the Italian system has taken place utilizing private resources until this moment. A public intervention will be soon take place, but that was the situation as of now. Now, the banking system, as far as liquidity is concerned, is quite satisfactory, but we have to be mindful of the fact that the financing source from the ECB was the effect of this expansive monetary policy, and the medium to long-term indebtedness of European banks has gone down remarkably. We have a problem with the exit from these expansion phases. The banks are going back to become funded on the market in the medium to long term, which will, of course, reflect the risk level of the European bank systems that the European bank system could incur into. You see some countries like Italy and Spain that have made recourse to the funding of the European central banks. In these systems, the reduction of the bond issues has been quite a major one. We're not going back to the retail market, but the funding to medium and long term is very important for an asset and liability balance for the bank. This is the situation of the return on equity gap that Mr. Angeloni showed you earlier, talked about earlier. And it is important to know the profitability gap versus the capital costs. You see a graph. The graph shows the European average, and the cost of equity has not changed remarkably. You see it's still at average levels in Europe. There has been a recovery in the profitability level, which is still very much different according to the various countries, in the different countries. In some countries, the gap is quite limited. In Germany, for example, equity cost is lower in spite of the specific situation of certain banks. Profitability is limited, but the gap is being filled. France is about to do so, Spain as well. As far as the Italian banking system, instead, you see a return on equity gap that is still quite a major one. So for the European banking systems overall, there are two relevant problems in order to close the return on equity gap. In the first place, to continue with the de-risking activities in order to reduce the cost of equity and reduce the blue line, while on the other side, carrying out actions aimed at make the yellow line increase, i.e. the return on equity line. These are two actions that should take place jointly and be as extensive as possible, because otherwise it will be quite difficult to close the gap. That's the major challenge. The stock markets have incorporated are reflecting such difficulties, as you see the price indices and you see the returns. The returns are still quite below the book values, which means that there are still some expectations in terms of future profitability that are clearly lower as compared to the investors' requirements or requests. But if we take a look at the Italian system, you see a further gap, so a further problem on top of the others. So we have to make up for this problem as well in comparison with the average European banking systems. What are the major drivers? You heard about the interest rates level on the banks. You see some effects of these activities. Some are positive, others are negative, as Mr. Angeloni showed you earlier. And these are similar representations of the bank equity price indices and short-term rate expectations. You see how the shares are performing on the different markets and the interest rates levels. There has been a reduction in the period of the low rates, whereby we noted a prevalence of reductions. In fact, the interest rates is particularly important in some countries, and you see how this correlation is changing. See, for example, the case of France. The expected level is in the French case, you see a recovery of the price index via costs or via the business model. There is a possibility to correlate or detach these trends. We can call it in different ways, but it always means reducing the revenues rate from the traditional intermediary activities. And I only have 5 minutes, then I'll be even quicker. So the cost problem, it is a relevant problem. There is a quite high level of differentiation within the banking systems. The Italian system has got a quite high cost level, and a series of estimates lead us to have a reduction of almost 50,000 bank employees to get to the same level of other banking systems. Half of such redundancy plans has already been approved of and will be carried out shortly. Still a lot has to be done. And the real problem is that of the non-performing loans. This is the coverage ratio and NPL ratio and the Texas ratio and NPL ratio that you can see. There are countries that are not aligned. Italy is one of these countries. So we have to go back to the right direction by reducing the non-performing level stock and increasing the coverage level. There's yet another point that Angeloni mentioned earlier of the level 3 assets, which is yet another problem concerning the quality of the assets. On the macro level, it is less remarkable than the non-performing loan problem, but there are major differences amongst the various countries, and the differences on average do not show any further problem or difference. Some banks have got a level 3 assets level that is greater, that is bigger than with other banking institutes. So we note that there is a problem there. It is a general problem, but the problem is one and the same. Once again, the level 3 asset bring some higher uncertainties within the banks, which means that we will have to carry out funding activities in the medium to long run, which entails a premium for the higher risk. The European Central Bank has carried out a guidance activity on the NPL, but another activity should also be considered in terms of indicating a plan or program in order to reduce for some banks the level 3 asset level. So that should be surely an option, an important option.
NPL is a problem. Italy has got 1 trillion in the euro area, 33%. 1/3 of NPL is concentrated in Italy. It grew quite a lot for many reasons, because of macroeconomic reasons, in addition to other more current economic situation-related issues. And economic cycle shows that this rate should drop. And so we should be able to reduce this stock. Let me highlight something now. And the inertia of these stocks in absolute terms, if no actions are undertaken, we would go to 2024 with levels that are absolutely much higher and further worse. And so these are the average recovery time, and this is a problem related to our legislation and court operations. So from 7 years as today, we get to 3 to 3.5 at the European level. So that would be the inertia in absolute terms. And so we have announced a plan, a sale plan of about 100 billion by the year 2019, and the ratio should stabilize so that these are non-performing loans that will be stabilized and reduced by 4%. And this is one of the activity that is carried out through sale and recovery. And as for the guidelines that have just been mentioned by Mr. Angeloni. And so this is something which is quite important to close with. a debate at a European level is going on whether such a problem exists. The gradual reduction plan, which absolutely might lead to significantly lower levels, is it sufficient or is it not sufficient? This is the point. Can we think of European mechanisms but implemented at a national level to make sure that you can have a sale and a transfer of these non-performing loans outside the bank financial statement? So discussion is going on in Brussels between operators and supervisory boards. That might be a possible way out. MC might be an important mechanism, instrument, because on the one hand it centralizes and makes the non-performing loan recovery process much more efficient as against the individual steps that might be taken by banks. And then through the securitization process, you can get to the reduction, downsizing, and better management of the problem. And so as far as the Italian case is concerned, that's what we have reached as a conclusion. That is very easy, apart from this diagram that might seem quite complicated. We've got 200 billion of non-performing loans at 85 billion net book value and 115 billion as provisions, as for the gross book value of 200 billion. So we should reduce that book price. What is the reference price? Our models show that a market price, taking into account recovery curves and so on and so forth, might be at around 25–28%. Let's take the more cautious scenario. At 25, you've got a transfer of 50 billion, and then you can build securitization mechanisms with the support and guarantee by the state, GACS, and 25 billion can be funded on asset managers market, namely bonds, low-risk securities, and so there is an important liquidity benefit. As for the rest, at 1010, that can be funded by long-term investors. If this is the price, and if the state subscribed the junior 10 billion share, that security would be 100, and the state support would be there for all the prices beyond 25. So this is what is now being discussed. Is 25 the real economic value that is now being discussed? Okay, let's talk about it. So this is a possible way to tell you that there is a possibility to find a major solution to NPL, non-performing loans, with the limited action by the public sector, even within the framework of the directive on state aids, within this European framework, and access rules have to be European. So what are banks expected to do to access this scheme? It's not a one-by-one agreement, as is now happening every time a restructuring plan is implemented. Individual one-to-one negotiations are started, but in that case, standardized rules are going to be applied, and in that case, can a solution be found with a major intervention and contribution by the public authority, which is limited to this figure. So that's what we are discussing at a European level. 100 billion and 30 mezzanine for insurance funds and mid and long-term investments, and possible public interventions that account for 30, 40, 45. And it is not only public support, only the additional part is as against the transfer price. So it's an amount manageable for a big issue that might therefore help the banking system to become profitable again, to reduce the gap in a significant way. That is all on my part.